So hello once again, everyone. This is Steve Taylor. I am the founder and lead advisor over here at Merited Wealth. And thanks for tuning in and listening to another episode of what I call Thoughts in Growth Mode. So my podcast and the YouTube channel, we do a couple different formats. One is more of an interviewing format of self-employed professionals and lessons to be learned and all the like. And this one, we really like to tackle a subject matter and kind of go through it, bring an expert in and kind of go through the process and hopefully once again for anybody that's out there listening, you may have brought this issue may have come up to you that hopefully you find this beneficial, and if you do, please let us know. Right, click below, leave comments, whatever, send us an email. So the topic today is a topic that really, if you're watching TV, you're listening to the radio, it's really grown in steam the last 6+ months, where it is the employee retention credit. Okay, so a lot of people are seeing commercials and hearing all these things, about it. But so let me introduce my guest for today, and he can tell you a little bit, about himself and his firm. But Rich, if you can introduce yourself, tell us a little bit about you.
Absolutely. Steve, first off, thanks for having me. Appreciate it. My name is Rich Pototsky. I'm a CPA. My firm's name is Miami CFO. And since the beginning of 2021, we specialized in the employee retention credit. We've processed over $200 million for about 600 entities all across the country.
Awesome, Rich. Okay, so let's start with really basic. Someone's tuning in, they're seeing this, they're not really understanding. What is the employee retention tax credit? Kind of where did it come from? Why is it here? Why is it such a hot topic?
That's a great question. So obviously, this is the last pandemic stimulus money still available. It was created under the CARES Act in March of 2020, the same CARES Act that created the PPP loan program. This is one of the two stimulus plans that the Congress came up with. Originally, they were mutually exclusive. And the way the math worked, you got more money, you got it from your bank, you didn't have to deal with the IRS. Everyone took PPP. So you fast forward to December of 2020, Congress was doing round two of PPP and realized they had a massive bucket of unutilized tax credits. So they changed the law in December of 2020 and allowed you to go back retroactively and claim these credits even if you took PPP. And then they increased the amount and the frequency of these credits going forward into 2021. The reason that's a big deal is because a lot of people went to their CPAs or their accountants and said, what's this credit, sometime during 2020? And the answer was, oh, you got a PPP loan, you don't qualify. And so there was a lot of misunderstanding for a long time after that. Well, my accountant told me I don't qualify, or this is not something that I'm qualified for because I took PPP. And so it was very much underutilized, probably up until middle of last year. I would say it's still only like 60% utilized. And we're going to talk about that later, but obviously the IRS has issued some warnings that has scared a lot of people off from even looking at this as well. And we'll talk about that later.
That's wonderful, Rich. Really, thank you for explaining that, because I remember at the beginning of 2020, right, we're all trying to figure it out. The CARES Act comes out. There's lots of provision in it. People are asking about, oh, you can borrow from your retirement account, all these different things. And there was confusion, right? Because no one knew how it worked, how it was going to play out. Because typically, rulemaking laws come out, then you see some regulations and you kind of have time to figure it out. But we were all such under the gun and under the pressure of it. So that's really, really helpful, maybe for some people that went through and they did go through the PPP and they were thinking about it in 2020, that they haven't really revisited it, right, since then. And so that's really helpful to know why this is becoming more popular.
And it's a lifesaver for a lot of small businesses. I mean, we're talking about it's up to $26,000 per W-2 employee. Okay. So it's, a 20-person pizza restaurant, they're looking at a possible $520,000 of a fully refundable payroll tax creded. So
what does that mean, Rich? Explain that to people, what refundable means versus like a normal credit. What's the
importance
of that?
A couple of advantages over PPP. So number one, it is a fully refundable. You're going to get an actual paper check from the government. It's a check in hand. You do not have any requirements. So PPP, if you remember, had a lot of strings attached to it. You had to use it for payroll or business expenses. You couldn't, in theory, you couldn't pay off debt. You couldn't, you couldn't buy fixed assets with it. It had a lot of restrictions. This money has no restrictions. It's an IRS refund, no different than when you get a refund on your personal 1040. So the check goes to the company, and the company can do whatever they want with it. So it's, the amount is $5,000 for all of 2020, and then $7,000 per employee per quarter for the first 3 quarters in 2021.
Okay, so let's walk us through that, Rich. Because I know the quarters are really important, and I know there's kind of a moving timetable, going through with this. Walk us through a little bit of the eligibility here, and so people can kind of like, hey, listen, that might sound like me. That I might qualify for that.
So there's 2 basic tenets to qualify for the credits. The first is a math test. It is they call the gross receipts test. The way the law is written, it says you had to have a substantial or significant decline in revenue. It's defined differently for 2020 than it is for 2021. In 2020, you would need to have a 50% drop in revenue in any quarter, second, third, or fourth, versus the base year of 2019. So specifically, we'd be looking at Q2 of 2020 when the world pretty much stopped versus Q2 of 19. If your revenue was down 50%, you're going to qualify for 2020 until such time as your revenue comes back to exceed 80% of that base year, right? So if you had a huge drop in Q2 and your revenue bounced back in Q3, you wouldn't qualify for Q4 in 2020 in that scenario. In 2021, you need to have a 20% drop in revenue. So Q1 of 21 versus Q1 of 19. If your revenue is down 20% or more, you're going to qualify for that quarter. You can qualify for one quarter, not the others. So it is done on a quarter-by-quarter basis. So the second way to qualify, so the one is very, very straightforward. It's math. The second one is a little bit more nebulous. The law states that if you were subject to a full or partial shutdown due to a government mandate, and it had to have a more than nominal impact. So there's 2 parts to it. So the first part, let's take the first part. It was written for hospitality, specifically restaurants that had an indoor dining ban. They wanted to get them their money. And so, but since then, as you mentioned, the lawyers get involved, people start interpreting the law. It's expanded. And there's a lot of, it's a case-by-case basis, but there's a lot of industries that will qualify based on, for instance, private day schools. They were shut down in 2020. When they reopened, they had capacity restrictions on them. Large nonprofits are usually very good candidates because any kind of after-school program, Sunday school program, summer camp, they're all going to qualify because they were all shut down for some period of time. Law firms are another one. So, law firms typically could have worked remotely and had done workarounds during the pandemic. However, every courthouse in this country was either closed or went virtual. And by doing so, if you did any litigation whatsoever, there were no jury trials allowed. There was, limitations on discovery and interrogatories that had a direct impact on the current or future revenue of the law firm. So the law firms will qualify. So it's, great. Yeah. And so there's definitely, it's industry by industry, things that you don't even think about. The construction trades, like the GCs and the sub trades, permit offices are closed for different times. And so if a permit office closed, you can't pull a permit, you can't work. So there's, like I said, there's lots of different ways to interpret it and take a look at it. My team's very good at having these mandates from all over the country. So if you're in a major municipality, we probably already have the mandates.
Is there a Rich? Is there any kind of guideline that's come down from the IRS on what does or is too tenuous or not too tenuous, or is basically offices like yours just left up to kind of figure it out, look at the mandates, and apply kind of the reasonableness test that we think, hey, we think this is close enough. I think we can file.
So obviously, there's no case law. I was one of the first ones into this, right? Let's be honest. When the law changed in 2020, late 2020, I jumped in with both feet and I became laser focused on it. In doing so, I had a lot of discussions with my contemporaries at the Big Four and the Big Six, right? So I spoke to the managing partner at BDO. I spoke to the managing partner at KPMG, and we kind of, all of us, came up with a consensus of what does it mean, because there is no guidance. And it was helpful because, I'll give you an example. For instance, there was some discussion about, does an owner's wages qualify as qualified wages, and are they eligible to take the credit? I took the conservative approach from the get-go and just said, no, any owner, anybody related to the owner, you're not getting the credit. That guidance wasn't issued until August of 2021. Well, I've been doing this for, at that point, 9 months, so it's kind of a little late. I'd already done a bunch of them. So luckily I guessed right. But they continued to issue guidance on this once a month throughout the month of July, and they've somewhat changed the rules a couple of times mid game, but that's to be expected.
That's the government.
Yeah, exactly. And
yeah,
so, but we know this law pretty much better than anybody at this point, and we're very comfortable with what we've done for our clients, and we know that we can defend them in an audit moving forward.
That's great. Yeah, we'll come to that because that's what the process is going to be. The government and all kind of regulated governing bodies are pretty much pros at not giving any guidance, but then coming back and say, well, no, that wasn't right, right? And so you have to have
the interesting part about this,
battle on that.
Yeah, the interesting part about this is they actually use the honor system, which we all know is not the greatest thing to do. So rather than ask for the substantiation up front, they're basically saying you can go ahead and apply for this and you'll get your money, but then we have the right to come back and audit later, and we may determine you're not eligible, in which case they would then owe the money back plus penalty and interest.
Right. So that's a really important part, right? So that when you're going and applying for this credit, while they might not be requiring it, it's really best practice, right, to collect it all and get that all ready for when they do come knocking on the other side.
If you believe you have exposure, absolutely. I mean, that's if you took an aggressive stance, then you've got some exposure for sure.
Yeah. Rich, in reviewing the laws also, I saw you gave us those great examples, and I saw there's kind of this definition of a recovery startup business, where it seems like a business that came about because of the challenges in the pandemic, that they're kind of niched in there. Have you seen many like that, or does that
absolutely
open up for another area of business for new businesses that started?
So anybody that started after February 15th of 2020 is deemed a recovery startup business. The way the law is worded, almost anyone will qualify, because you would have to average $1 million in revenue. So you'd have to be doing $3 million in revenue by 2021 in order to not qualify. So bottom line is you get up to $50,000 in the third and the fourth quarter of the credit. So it's $100,000 for a startup business, and the bar is very low to qualify. Like I said, almost every startup will qualify for that $100,000.
Got it. And there's no base year comparison like 2019, like to the other two tests. That's just this startup gross revenue, and you would qualify. So that would potentially be almost easier because you don't have to show any kind of damages.
Correct. That's right.
Okay, interesting. So it's really interesting, Rich. So that's really helpful. I understand. I see how these businesses are out there and how they're going through it and these different opportunities. So you've been going through, you've been working on these and working with these clients. What are some of the things you've been seeing, whether it's certain areas or businesses or just demographics that you're seeing, some best practices or some caveats as you've been making these filings the last 2 years?
So obviously, it's really important that it's only W-2 employees.
Okay.
There are a lot of people out there being very aggressive with their marketing. Just to be clear, I have not done any marketing per se at all. Right? Every client I've gotten is a word of mouth referral. But there are definitely some firms out there who are spending an awful lot of money in radio advertising, direct mail advertising, targeted Facebook ads, and they're spending $10 million a month, and that they're doing that because they can generate that kind of revenue on the other side of it. The IRS has issued about 4 warnings now regarding what they're calling ERC mills, right? People who are taking advantage of the system, charging upfront fees, charging very high contingent fees to do this work. And I would just say buyer beware. I've had clients come to me where I tell them they don't qualify, and I know down the road they went down the street and found somebody that would do it for them. You're just asking to have a problem down the road. It's difficult because they'll come and say, well, my buddy who also owns an HVAC company, he qualified. How did he get his money? Well, I don't know the revenue of the other company. I don't know the situation of the other company. So that's a very difficult question to answer. There are certain industries that are very difficult to qualify. For instance, home health care. Typically, their revenue was up 2 or 3x. There was no mandate that impacted their ability. They were deemed essential. And so right there, if you don't pass the revenue test and you were deemed essential, it's very difficult to prove that you were impacted at all during the pandemic. So, the flip side of that is I've got my first client provided linens to all the spas in Miami Beach. Well, the spas were closed for, months. So he obviously qualified on revenue and desperately needed the money. There's another gentleman up in Broward who has a specialty company that does rentals to the cruise line industry. And when I say rentals, I mean walkers, oxygen tanks, wheelchairs. So these specialty items that people need, medical equipment, when they go on a cruise. Well, I don't know if you remember, but cruises were 15 months, right? So it was from March through July of 21. He did not have $1 in revenue. So as long as he maintained payroll, he would get credits for the people that he actually paid. I mean, it's an employee retention credit. The purpose of it, just like PPP, was to protect employees and keep them on the payroll rather than have them go on unemployment.
Rich, one quick technical question there, because you said that the PPP and the ERC used to be linked, but then they were no longer linked. If you basically were able to maintain payroll in part, or if not totally, because of PPP, would you then be able to go in later and say, hey, listen, I maintain payroll, even though it's coming from PPP?
So the answer is it depends.
Okay.
So there's when you filed for forgiveness for the PPP, you could use 60% of the PPP for payroll costs, right? So that other 40% would then be eligible for ERC. You cannot double dip. You cannot use the same payroll dollar twice. So as long as you have what we call excess wages, wages above and beyond what you use for PPP forgiveness, those excess wages would be available for the credit.
Great. And one other question, Rich, when they receive this money back, is that considered taxable income?
It is. So the IRS was very adamant about this. So let's say you're going to, we filed now, it takes 5 months. We'll talk about that, but 5 months for the IRS to issue a check. So you may not receive it until 2024, but it's actually taxable income in the quarter that it was generated, meaning you'd have to go back and amend your 2020 and your 2021 income tax returns. So it's you don't have to pay the money back, but it is taxable. So effectively, even if you're in the highest bracket, the government's giving you $1 and you got to give them back 37 cents. So you do that until you run out of dollar bills.
Interesting. Okay, so we're still going through this, and Rich, at what time period, to give anyone who may be listening an idea that's saying, hey, listen, if you wait too long, you're going to have missed out the time period. When do people need to be thinking about deadlines in order to get their filing done?
So there's 2 different deadlines. You're filing amended payroll tax returns. The first deadline for that is April 15th of 2024. So they've got about 10 months to hit the first deadline. For 2021, it's going to be April 15th of 2025. So those are the 2 deadlines. So you'll lose the 2020 credits next April, and then the following April, the whole program stops.
Great.
Assuming it's not shut down by the legislature before that. But
right, at any time. That's always a possibility. So, Rich, someone's gone through this. They've worked with you, or they've worked they've received their credits through some other fashion, and they've gotten it. I guess they've gotten the money. They're going to amend their income tax returns and the like. And are they free and clear? Do we have nothing further to worry about this, or is there something they should be thinking about?
They should always be thinking about an audit potential. So, unfortunately or fortunately, the IRS just got $80 billion and they hired 80,000 people. Those auditors started in October of 2022. The first audit letters just went out in the first week of April. So out of my 600 clients, I've had 3 that were selected for audit already. We've successfully defended 2, and the third one was just a half an hour ago. So I'm hoping to get that determination letter early next week that we're clear. That being said, the IRS audit period goes through 2026, and I believe that they're going to extend that. The estimates I've heard between PPP and ERC is over $1 trillion in fraud. So the IRS literally is looking for people that filed for the credits and either had no basis to claim the credits, or they made up the W-2 employees out of whole cloth, which is, we saw with PPP. There was a lot of that happening. It's more difficult with ERC just because of the nature of it and the fact that you're filing an amended payroll tax return, and if you didn't have employees pay in, can't get the credit. But certainly, if you were told you don't qualify and you went ahead and submitted anyhow, that is technically tax fraud. And so it's going to be interesting to see how this all plays out over the next 3 to 5 years. Let me give you a worst case scenario. You're contacted by one of these ERC mills. They're oh yeah, you qualify. OSHA requirements. You had to wear a mask. That is not a qualifier. but they're going to tell you that based on distancing regulations, your business was impacted, even if your revenue was up double. Oh, no, your business was impacted, you qualified. So bad advice. You go ahead and you file it, and let's say you've got 40 employees, you're getting $1 million. So typically these other actors charge 25%. So your $1 million is reduced by the $250 you pay for a fee. You have to pay the 37% to Uncle Sam for the taxes. So you've netted 380 out of the original million. You get audited 3 years from now. The IRS determines you didn't qualify. You owe the $1 million plus interest plus penalty. So it's going to be significantly more than $1 million. You're outside the scope of being able to amend your income tax returns because it's a 3-year window for that. So you can't get back the 370 grand you paid in income tax. And good luck finding the advisor who told you that you qualified and getting that 250 back. So you're holding 380, you owe $1 million plus, and you have very little recourse. It's going to be a problem.
That's interesting whether that goes out. If I understand, that 3 years, and let's say if it wasn't because of fraud, right? But you have to go back and you pay back, you just didn't qualify. They say they're not going to allow you to amend, and basically they'll ask you for money that you paid already to the IRS. So that's going to be an interesting conversation. We'll see how that works out. But let me ask you this, Rich. So somebody then has gotten it and they get this audit letter. What is the best idea, the best advice you would give to them that once they got that letter, what they should do? I think number one would be don't, if they want, but they can, but don't necessarily contact the IRS right away. But what's kind of the best steps for them to handle getting that notice?
So typically they have a 30-day response time on these letters. I would absolutely find a professional tax advisor, either a tax attorney or a CPA, and have them review whatever it is that you submitted originally and your basis for why you believe you qualify. Certainly that's something that we'll be providing, additional clients as well. But, basically for that audit file, and the other problem is when the IRS is there, similar to when you get stopped for a broken taillight, they're going to ask you to open the trunk. The first client that got audited, they asked for their entire general ledger, which they're doing a payroll tax audit. They had no reason to see the general ledger, but they're going to just kind of peek under the hood while they're there. But certainly the advice would be hire representation, make sure you've got all of your I's dotted and your T's crossed, and know what your exposure is. For instance, one of my clients, they had 3 brother-in-laws that they didn't tell me were on the payroll. They had a different last name. But, once we got to the audit period, we self-disclosed that, and that was the adjustment, was $15,000. So certainly better to do that, give the IRS the win, and know where you are than have to worry about, losing the entire amount.
Always. That's settlement, that's negotiation 101, and especially dealing with the IRS. And I tell people this all the time, that if you wait for them and they come knocking at your door, it's really in trouble. If you come forward and say, hey, listen, we think we made this one error, give them their wins, that makes everything completely different. And I think that's great advice. So Rich, I really appreciate this time today. I'm going to put your information and the information about the firm and anything below. If anyone has any questions on this or any ideas for future topics or anything like that, please let us know. Email us at podcast@meritedwealth.com with any other ideas or anything like that. But I just want to close. I want to thank you, Rich. I really appreciate all this advice. If there's any final nugget you'd like to put out there, please let us know.
I just appreciate the time, and good luck, everybody. Thanks.
There we go. Good luck to all of us, right? Sounds like the pandemic was starting over again. But thanks everyone for listening.